Hi, welcome back to another episode of Talking Stocks. It's what we do. I'm here today with a very special guest. I'm here with Jeffrey Hirsch, who is, I'm going to call him, you know what, Jeff? I'm just going to call you the seasonality guru. How's that? Seasonality guru, Jeff Hirsch. Jeff.
Do I have to get in some sort of like yoga pose to be called a guru?
Right. You know, maybe we'll create some new yoga poses on Pilates. Who knows? We'll just go wherever the show takes us today, talking stocks. But I'm really excited to have Jeff here on the show with us today because I started out in the business about a little over 20 years ago. And one of the first books I bought when I started managing money for institutions and selling research was the Stock Trader's Almanac. And I just want to, for prop purposes, Jeff, here it is, the 2001 edition, my first one. And I tell you, I still have it today. It's well worn. I do have also the new edition, and I'm looking forward to talking to you.
You got it open to the right page there. I see.
I do. I have it on the March setup. Jeff, I was doing a little bit of digging into your background, and I was fascinated by your father, and just for listeners out there who may not be familiar with the Stock Trader's Almanac and what your dad has done, and I assume you were standing over his shoulder as a toddler, looking at what he was doing and helping him with the boxes. I mean, maybe you could just give us a quick background.
Well, you just reminded me of a story. Speaking of, I don't know if I was a toddler. I might have been a little bit older than a toddler for this, but he used to, once he moved the office back to our house, he converted the old garage into an office, finished it, and put a new garage on. He was tired of commuting into the city. And, he kind of used the dining room table a lot for meetings. We had writers in the house and stuff. And I remember coming in to say goodnight to him in my pajamas or whatever. And they were looking at charts. And he's like, what do you think of this chart? Is it going up or down? And, I probably said up or something because, whatever. But I think might have been Polaroid or something. Who knows? But, I really learned from the ground up. We started out in the mailroom. He had an interesting history. I mean, he was in the songwriting business, the music business. He had a degree in music from Brooklyn College on a GI Bill, even though they bounced him around from, training to training. He never really actually saw action over there. His brother did. His older brother, my Uncle Harold, was in the Patton's Army, the mechanized second wave at Omaha Beach. He was in Maurice Rose's Army, who was the highest ranking Jewish Army general or Army officer. I think it was a general, 1-star. Anyway, I digress. But he started Indicator Digest in Palisades Park, New Jersey, run by his cousin, my godfather, Sam Kozlow. So then he went out in his own. He had the epiphany to take all these indicators, patterns, cycles, trends, and organize them in the calendar format that you look at there so he could follow the market schedule along with his own. And so the rest of us, could. Obviously it hit. So he broke out on his own in 1966 when my mother was pregnant with me. Just kind of a conservative move,
What could go wrong?
And he did all the research, took all these patterns and stuff, and then started developing his own. Like in 1972, it's the January barometer, Santa Claus rally. Those are all his inventions. People get some of those wrong. And then, big proponent of the 4-year cycle. And 1986, he created the best and worst 6-month switching strategy. Everyone talks about sell in May, and we don't go away, but some people that's the old British saw. But you gotta remember to buy in October to get yourself sober, as I always try to come up with a little rhyme. It's not the greatest one, but
it works.
So I started packing books and shipping them out. I mean, we sold a lot to brokers and advisors. Back then, it was all brokers. And then we were big into the newsletter business. At one point, when I was working with him in the 90s, we had about 6 newsletters we were publishing a month.
Wow,
it was a lot.
Wow, that is a lot. I mean, you covered a little bit of ground there talking about some of the indicators that you've kind of built the pillars of success around the Stock Trader's Almanac. And one of them obviously being the January barometer, which I think is a very important. I don't know if you'd call that the most important. I mean, if I put you on the spot, would you say that's what do you think is the most important of the indicators that are incorporated in the stock?
Of the seasonal indicators, that's probably the granddaddy of them all. But I think the most important seasonality pattern that's kind of more tradable is the best and worst months. And then, one of the things that blows me away is it's one of the calculations I used to do back in the old days. We used to run the numbers, and I know not like a bookie, but calculations for the and the monthly cash flows on page 147 that you are familiar with, I'm sure. The days of the month the trading days of the month that work best, and also the intraday trading patterns. Funny thing, last night I was watching, I've been checking out Shep Smith, the news with Shepard Smith, on CNBC. Sure. Some good coverage, not always the same old stuff. And they showed the GameStop thing, and I actually snapped a picture of it. The intraday trading pattern of GameStop yesterday, forgetting about all the hype in the news, and that's another story. Tracks, look at page 139. Since we have our guidebook here, right? That top part. I mean, there was a noon dip and a 2:30 dip in GameStop. I mean, I guess I could show you on the phone if you wanted to see it. It just blew me away. I was like having my dinner, and let's see. Look at this modern technology. See, doesn't it look similar to the chart back there? So, despite all the high frequency trading and the algos, there's still humans that program these things, and there's still people that got to look away from the computer. And you got that 2:30 dip and that rally to the close. I mean, everyone's like, you get a little sleepy there, siesta time, 2 o'clock, got to go grab another coffee, a Diet Coke or Red Bull, whatever you do, or a bonbon or some whatever you do. I do coffee, but it still amazes me that these behavioral finance patterns of how people consistently and repetitively do the same things with their money, these patterns persist. I mean, you've got COVID, which will knock it for a loop. There's other things, there's news flows, but overall, people continue to do the same things at the same times a day, week, month, year, quarter, and presidential cycle.
It's fascinating that you say that, because I think that, one of the things, if you're not familiar with seasonality, if you've never incorporated it into your process, you're probably asking yourself, well, why should I care what happened, 30 years ago over some period of time or anything like that? And you really just hinted towards it, I think, which is that old Twainism, right? History may not,
repeat, but it rhymes.
Yeah, but it rhymes. And I always kind of look at it in the degree of tendencies. I don't know if you look at how you look at seasonality. How would you say, if you were talking to one of my students?
Probabilities.
Yeah, probabilities. Okay.
And we don't just use one time frame. I mean, to add, this is one of the things we do, standing on Yale's shoulders. Like with the January barometer, we take the Santa Claus rally, the last 5 days of the old year, first two of the new year, plus the first 5 days early warning system and the January barometer, and we got our January indicator trifecta. So we're building, on things. With our seasonal patterns, especially with the, what we do with the Probabilities Fund, is we track those Super 8, Super 7 trading days, which are different for each month. But we look at it over 3 time frames, back to 50, post World War II, back to either 71, which is when NASDAQ started, or 31 years, and then the recent 21-year period. So we're looking for clusters of frequency and magnitude where, the market does the same type of thing or a consistently similar thing on a regular basis. And you're looking for things, 60% of the time or better is a bullish day. If the S&P is up, or versus down, it's a bearish day. Weeks after triple witching, especially June and September, notoriously weak periods of time where positions are squared, and it mirrors the flows of pension funds. And just to make sure this is not, we're not pure seasonal. Seasonal is our behavioral finance foundation. But when I pick stocks and I look at the market, I could do some technical analysis as well. I got some charts. We did a lot of that back in the day. Trend lines, we got pivot points now, moving averages, dojis, candles. I look at these things, and we look, and when we pick our buy limits for stocks, we recommend stocks using a fundamental screen during the seasonally ripe time with a technical analysis, buy limit, technically analyzed buy limit and stop loss. Also some relative strength. We look at, I'm a big fan of put call ratios and investors intelligence, bullish percent, bearish percent advisors, as well as advanced decline lines, new highs and new lows, market internals. So it's not just seasonality, but it gives you another edge. And you hear it everywhere I go. I'm listening to the news flows. Oh yeah, oil's seasonally strong right now. No kidding. Look at page 92. It's right there.
Right. And it's like another tool in the toolbox. You know, I mean,
Precisely.
why would you, if, you know, and sometimes the hammer is the right tool, and sometimes the wrench is the right tool, sometimes the screwdriver is the right tool, but why would you not have a screwdriver in your toolbox, right? Because in my view, if I can get an edge, and use that word edge, I love it. If I can get an edge, why wouldn't I take advantage of it? And it's uncanny. It's uncanny how
We call it the calendar edge.
the calendar edge. It's uncanny to me. I mean, we talked just briefly, you had mentioned the post-election cycle and looking at it. And I tell you in the book, I mean, if you look at February and March, I don't think it's any, you know, it's interesting. It's very interesting to me because you see NASDAQ 8th and 9th months for returns historically in the post-election period. And I think in both February and March, historically a negative average return.
A little bit weaker. And also, if you look at, was it page, is it 88, I think, is the fourth quarter magic? No, that's the trading days. Or 100 and something. Q4 market magic.
Yeah, I'm not sure exactly.
102. 102. Look at Q1 of post-election year. 102.
Yeah, got it.
So you're jumping on the weakness in February and March in post-election years. Also, Q1. I mean, you're talking about new presidents, markets adjusting to new policies. I mean, this is what makes the January barometer tick. You got new Congresses convening, you got new presidents taking office, or old existing presidents making policy decisions and discussing their initiatives and agendas in States of the Union address. States of the Union address, or addresses, I guess. State of the Union addresses. Sorry, that's the editor hat. So, yeah, you know, political cycles. I mean, people are looking at what's going on in D.C. from around the world. Yeah, you got some other countries that have some clout also, but we still have a lot of driving power here in the, you know, economy of the United States.
Yeah, I mean, in the thing is they pay the piper. You know, sometimes you have to pay the piper, and I think it was March, and you know, maybe we're doing that. So I mean, I assume, just to extrapolate, because I'm sure some of the listeners here are, you know, looking at their stock accounts, and they're looking at their NASDAQ holdings in particular. It would seem to me that you're not surprised necessarily by the action that we've seen in some of these tech and NASDAQ stocks, and corresponding to the increase in energy stocks that we've recently seen. And so what would you, is this in keeping with what you would think should happen? Or
it's in keeping, but you got to remember to anticipate this stuff. Like, we were recommending energy stocks before this big move. That's where the seasonals come into play. We were talking about, you know, post-election year weakness in February and March ahead of it. And then I look at some technicals. I mean, there's about a 10% correction in the NASDAQ 100, or the Qs, from the February high to that March low. And, you know, I got to clean up some of my support lines. I put a whole bunch on there. I got to clean. It's too much for other people to look at. You know, people say these charts are too busy, but there's some interesting levels. There's the September doji top, you know, is a great support level. You got that little W123 bottom, and also, you know, the sort of higher low bottom in October with that slightly trending up line. It's a great support line. Very typical seasonal behavior in September, October. November, for the record books, a little bit more than everybody expected, but one of the best months of the year, especially for small stocks. Not surprising, except the magnitude was a little bit more than a lot more than usual, which you know, it'd been pent up for a little bit.
Yeah, and I think that when you're thinking with the NASDAQ too, and that 10% pullback, and I think there might have been a Fibonacci level that got kind of close to as well on that. You know, and right now I think probably like many people were watching for that follow through day. See if we actually get that follow through day with an up 1% day with higher volume than the prior day.
And then I will bring in the seasonals again. You know, we've got mid-March here. Very strong period of time. Look at your March almanac. Look at the bar chart on top of that page. Okay, you see we're getting some of that. It's not exactly the same time. I think it was about a day or so early than the averages, but you got that spike. Now, we discovered that when I started working for Yale full-time back in the 90s. And that mid-month spike is driven, you know, behaviorally and repetitively by the payroll deduction, the mid-month payroll deduction going into the 401ks and the IRAs to the pension and fund managers, institutions. They got to put that money to work. Mutual funds, you can't sit on cash. You got to deploy that by regulation.
Yeah, I mean, most of my mutual fund clients, so they'll run maybe 2 to 5% cash tops. You know, I mean,
you got to put that money in, and that's another reason for the October seasonal low is that October 31st deadline for transactions for making distributions by year end. I mean, it's the calendar, man. You know, it's there. So the caveat I was trying to get at when you're talking about looking for that follow through day. But we're looking at a week period of time at the end of March. The week after triple witching, was it down? It says it on page 15, 35.
See the bars on my screen too. Just
yeah, but we also have a note there in the diary page on page 35. Excuse me, scratch that. Next page.
36.
37. Week after triple witching, Dow down 22 of last 33. And then end of March tends to take some serious hits from selling pressure. That's, quarterly pension flows, people taking profits. So we're looking for that follow through day. We might not get it until April, best month of the year for the Dow, so.
This chart right here was fascinating to me because it shows, you can see the top one is the NASDAQ and it's the post-election year average, and we're talking page 44. And you can see where the NASDAQ in the post-election years kind of trends down into that March. And then boom, in April, really looks like it starts to rebound. To your point, maybe watch for multiple things to coincide together. There's no reason necessarily to take on too much risk. Let this sort of play out, because
if you didn't get in during the week this earlier, there's a dip. We do a typical month chart on our blog, Almanac, which gets popped out through Twitter to @Almanac Trader, and you can get it from our website, stocktradersalmanac.com, obviously. But first day of March, strongest day by magnitude. Look at page 88. You can see that there, and then there's a dip in after the first few days of March, and then we got this mid-month spike. So if you weren't in ahead of that spike, you got to buy those dips, and then you have another potential seasonal dip. And if it presents itself, that might be a nice opportunity for an April trade if you're going to do some seasonal swing trading like that. I don't do that as much. I mean, we have different biases on every day of the year for the Probabilities Fund, but in a newsletter portfolio and for like personal account, I'll do the best and worst 6 months using the diamond, spiders, cubes, and IWMs. Hope everyone knows what my little nicknames for that.
Yeah, ETFs.
Yeah, but the DIA, the SPY, the QQQ, I call them the cubes because it's 3 Qs, and then the IWM is the Russell, and we put out signals for that. So and then the sector rotation for the oil seasonality sector, the ETFs there, XLE. You can use the commodity-based ones as well. And then for our stocks, we're looking for, under the radar, acceleration of revenue and earnings growth, good valuations, relative strength, not ahead of the S&P or the sector or the market, and not trailing. So, we have a nice screen, pretty solid screen that's beating the market. So for that stuff, I'm not doing swing trading. I'm not doing that kind of thing. We're looking to hold those. And you know what? The key for everything we do is check that emotion at the door, stick to your system, have a ruling reason for getting into an investment, have an exit strategy, and then sell your losers short or cut your losses short, let your winners ride. We sell half on a double. Go ahead.
Yeah, I was just thinking about O'Neill when you were talking. I was thinking about, how you talk when you put these trades on. Are you saying to yourself, hey, maybe I'll trim some up when it's up 20-25%? Or are you just saying, no, I'm going to kind of let these other things play out longer? Or do you trail it with a stop? Or how do you?
Yes. It depends upon the strategy. So we do trailing stops, and we look for our stops, not like with O'Neill, 7-8%. We'll have it a little bit tighter for big caps, large caps, and looser as we go down the capitalization scale. But we're looking for levels in that chart: consolidations, gaps, pivot points, moving averages. And then the general selling, or profit-taking methodology is number one, sell half on a double.
Okay.
Take your initial investment off the table, especially with the small caps and even smaller. And then the other strategy, if you want to employ, is up 40%, sell 20%, up another 40, sell another 20. You're not going to get every little point of that game, but you'll get a lot more. And if it keeps going up, just let it go up, unless you find something more attractive. And we also roll into seasonals, from our MACD buy signal in October, November, whenever we get it, starting after October 1st, we'll be more aggressive. We'll have looser stops, and we never put a stop on the best 6 month switching strategy because that's pure seasonal. Yeah. And then when we get into the end of the best 6 months, when we get our sell signal, the sell in May period, if you will, we don't sell in May. We reposition.
April, right? That could be in
Say again?
That could be as early as April, right?
Could be as early as April 1st. If we get a fresh signal and it's confirmed by both the S&P and the Dow, NASDAQ and Russell go 8 months to June. We look for after June 1st. And on the sell side, we look at 1226.9 for the MACD. On the buy side, it's 817.9. Shorter, faster for the bottoms, and slower, longer for the process of making a top.
Makes sense. During those other periods, do you just go to cash? Or will you try and take some more defensive posture where you say to yourself, in the summer, I'm just going to own T-bills?
We do both. In the tactical, seasonal switching strategy portfolio, we'll go into bonds like the BND or the AGG. In the stocks, we will go into defensive type stocks, staples, utilities, things that are kicking off dividends that aren't as volatile in the summer. And then for the sectors, we'll look at those sectors that do well in the worst 6 months, as I mentioned, utilities and bonds, and there's a couple others, staples, and biotech also you can get in there in the late summer. So there's a flow to the year. It's kind of like Alice's restaurant, where he says you gotta wait for it to come around again on the guitar. You gotta wait for it to come around again on the calendar.
Yeah. Yeah, it's fascinating stuff. And I think that what it does is allow you to have some more discipline, be a little less emotionally driven. And like I said, it's another tool in the toolbox that can help you with your decision making. And it sounds like it's not limited to just, the ETFs. You're doing with the Probabilities Fund, you're doing individual stock selection as well. Probabilities
Fund is not individual stocks. That's an ETF strategist. Okay, individual stocks is in the newsletter. Probabilities Fund is just but that's every day. We have different leverage planned out. We have a risk metric based on a VIX to trim back leverage if volatility kicks up. But that is based on basically the Dow, S&P, and NASDAQ, the NASDAQ 100 ETFs.
So just to sort of you're busy. We got all sorts of things going on today, but I just want to sort of come back to the post-election year and kind of the cycle and what you might expect throughout the rest of the year from here. What are you thinking based on looking at the information that's in front of you as of today?
Well, I'll tell you, but I'll direct you to page in my intro, in my Outlook, page 9, I think it is. There's a chart there, which I think you might want to look at, and we've done some additional layers on that after the election with new Democrats, new first-term Democrats, and we're expecting some potential weakness here at the end of March and a Q1 rally in April. That May-June disaster area, which has come and gone, but there's still weakness there. I wouldn't be surprised if we had some weakness there. Probably some strength in July, first month of the third quarter. The beginning of the second half tends to have a push higher, and then August, September. Last year, August was great. It was, the COVID was wrapping up and people were starting to open up. But August, September, weak period. I would expect that again. I think seasonals have been back on track since September of last year, and I would look for, pretty much sideways action from May through October with a couple of dips. I don't expect a bear market, and then rally to the close. I got a number in our base and best case scenario somewhere in the 42 to 4,300 area on the S&P for the year, maybe a little bit higher, depending on how well things go.
That's awesome. It's a great summary. And I think it gives a nice little roadmap for people. And geez, Jeff, I tell you, that was a fun conversation. I hope we can continue it at a later date. I really appreciate you taking the time today to come and talk stocks with us.
Thank you for having me. I look forward to it.
Fantastic.
Good stuff.
Bye-bye.